18 months.
That's how long it took Luckin Coffee to go from zero to NASDAQ. October 2017, first store opens in Beijing. May 2019, IPO on the New York Stock Exchange, raising $651 million. Stock price hits $51. Valuation climbs past $12 billion.
18 months to become China's largest coffee chain, surpassing Starbucks with over 4,500 stores. 18 months to become a national symbol of Chinese tech innovation. 18 months to convince Goldman Sachs, Credit Suisse, and some of the world's smartest investors that this was the next big thing. Then 11 months for it all to collapse.
January 2020, anonymous whistleblower report. February, short sellers publish damning evidence. April, company admits to fabricating $310 million in sales, nearly half its reported revenue. Stock price crashes 75% in a single day. June, delisted from NASDAQ. December, $180 million fine from the SEC.
The fastest growth story in modern retail had become the fastest fraud exposure in financial history. But here's what makes the Luckin Coffee scandal different from every other corporate fraud you've heard about. It wasn't sophisticated. It wasn't some complex derivative scheme or hidden off-balance sheet accounting. It was shockingly simple. They just made up sales, fake transactions, phantom customers, coffee that was never brewed, never sold, never existed, except in falsified databases designed to fool auditors, investors, and the world. Welcome to the story of Luckin Coffee, where ambition met deception at $310 million, where China's answer to Starbucks turned out to be China's answer to Enron, where a serial entrepreneur burned through investor cash faster than his stores could brew cappuccinos. This is the rise and spectacular fall of a company that proved you could fake your way to a multi-billion-dollar valuation, but only until someone started counting the actual coffee cups. Pull up a chair, order a latte. Let's talk about how to commit $310 million in fraud while the world cheers you on.
Beijing, China, 2017. Lu Zhengyao had a problem. He was running out of industries to disrupt.
Born in 1969 in Pingnan County, Fujian Province, Lu came from modest means. Father was a craftsman, mother a village cadre. But Lu was ambitious, driven. The kind of guy who quits a comfortable government job in his 20s because the dress code won't let him wear fashionable pants. I wanted to wear fancier pants, Lu later told Chinese media. That's how you know you're dealing with someone who either has vision or spectacular hubris. In Lu's case, both. By 2017, Lu had already built and IPO'd multiple companies. In 2007, he founded Car Inc., China's largest car rental company, modeled after Enterprise and Hertz. Lenovo invested 1.2 billion yuan. Lu immediately spent half buying cars, flooding China with 11 rental branches in the first year.
Then came UAA, a car service club. Then UCar, a ride-hailing app that competed with Didi by owning its own fleet and hiring professional drivers instead of relying on freelancers.
Lu's strategy was consistent. Identify a massive Western business model, copy it to China, spend investor money at ridiculous rates to achieve scale faster than anyone thought possible. Worry about profits later, much later, possibly never. It's called cash-burning growth. Silicon Valley does it. Chinese tech firms perfected it, and Lu Zhengyao was one of its most aggressive practitioners. By 2017, he'd established a pattern: start a company, raise huge money, grow insanely fast, go public, let the stock market worry about whether the business actually made sense.
But the car industry was getting crowded. Didi dominated ride-hailing. Tesla was coming to China. The auto sector was maturing.
Lu needed something new, something that could scale even faster than cars, something every Chinese urbanite used daily, something Starbucks dominated but hadn't fully conquered.
Coffee, the Starbucks problem.
In 2017, Starbucks had about 3,000 stores across China. They were everywhere in first-tier cities like Beijing, Shanghai, and Shenzhen. But they had a problem.
They were expensive, and Chinese consumers, especially younger ones, wanted convenience more than ambience.
Starbucks made you come to them, sit in the store, pay premium prices. It was the American coffeehouse experience transplanted to China.
Lu saw an opening. What if you created a coffee chain that was
Cheaper than Starbucks. Faster than Starbucks. Order on an app, pick up in minutes.
More convenient, delivery to your office, kiosks everywhere.
Aggressively promotional, discounts, coupons, free drinks. Starbucks was selling the experience. Lu would sell the caffeine.
In October 2017, Luckin Coffee was born. The name combined lucky with kin. The logo was a minimalist blue and white design, modern, tech-forward, Instagram-ready.
Lu recruited Qian Jia, a former Car Inc. executive, to be CEO. She'd helped him with UCar and understood his cash-burning, scale-first philosophy. She knew how Lu worked: move fast, break things, worry about sustainable business models after you've conquered the market.
The strategy was brutally simple. Grow faster than anyone's ever grown before. Become unavoidable. Flood Chinese cities with cheap, convenient coffee. Force Starbucks to compete on convenience instead of experience. January 2018. First stores open in Beijing and Shanghai. October 2018. Luckin had surpassed Costa Coffee to become China's second largest coffee chain. January 2019. Lu announced plans for 2,500 more stores.
May 2019, NASDAQ IPO, $651 million raised, 18 months from zero to public company.
The growth was insane, unprecedented. Starbucks took decades to reach that scale. Luckin did it in a year and a half. Wall Street loved it. Chinese tech companies were hot. Luckin looked like the next Alibaba or Tencent. Analysts called it the Starbucks of China. Media dubbed it coffee on steroids.
Lu's sister's investment fund owned 12.4% of the company. CEO Qian Jia owned 19.6%. Lu himself owned 30.53% and controlled the board. It was a family business dressed up as a tech unicorn.
And the money poured in. Series A, $200 million from Centurium Capital, Joy Capital, and Singapore's GIC. More funding rounds, more investors desperate to get in on the next big Chinese success story. By late 2019, Luckin had 4,500 stores. They'd overtaken Starbucks in store count. The stock price hit $51. Market cap exceeded $12 billion. Lu Zhengyao was a billionaire again. Qian Jia was on magazine covers. Luckin Coffee was China's pride, a domestic company beating an American giant at its own game.
There was just one problem. It was all fake.
The numbers didn't make sense. They hadn't made sense for months, but nobody was asking the right questions. Here's what Luckin claimed: rapid customer growth, increasing sales per store, expanding revenue. A path to profitability was just around a corner. The losses were temporary, necessary investments in growth. Once they hit scale, the unit economics would work.
Classic tech startup narrative. Amazon lost money for years. So did Uber. Growth first, profits later.
But something was off. The numbers didn't make sense. They hadn't made sense for months, but nobody was asking the right questions.
Muddy Waters Research, a short-selling firm famous for exposing Chinese frauds, started getting tips in late 2019. Anonymous sources, employees, people inside Luckin who knew what was happening.
The tips said, the stores aren't selling as much coffee as Luckin claims. The customer numbers are inflated. The transactions are fake.
Muddy Waters sent investigators to China. Over 11,260 store hours of observation across 620 stores. They monitored locations, counted customers, tracked actual foot traffic. The results were damning.
Luckin reported an average of 242 items sold per store per day in Q3 2019. Muddy Waters' on-the-ground investigation found closer to 150 items per store per day.
That's a 61% inflation rate. Luckin was claiming nearly double the sales it was actually generating. But how? How do you fake sales on that scale? How do you create phantom customers buying imaginary coffee?
According to the SEC's later complaint, Luckin employees orchestrated 3 separate fraudulent schemes between April 2019 and January 2020. Scheme 1. The voucher loop. Luckin sold coffee vouchers to corporate clients, companies that would buy thousands of vouchers at discounted rates for their employees. Normal business practice. Except Luckin was selling these vouchers to related parties, companies controlled by Lu Zhengyao, his family, or close associates. The corporate customers were fake. The companies would buy hundreds of thousands of vouchers, but the money flowing into Luckin often came from loans or intercompany transactions that essentially meant Luckin was buying vouchers from itself. Then Luckin would record these voucher sales as revenue, millions of dollars, all fabricated. Scheme 2. The fake transactions. Luckin created entirely fictitious store transactions. COO Liu Jian and his team built a separate fake operations database, parallel to the real one, that showed inflated sales numbers.
Real database. Actual customer purchases. Maybe 150 transactions per day.
Fake database. Same real transactions plus hundreds of phantom transactions. Total 242 per day. When auditors requested sales data, Luckin provided numbers from the fake database. The book showed explosive growth. The reality was mediocre performance dressed up as success. Scheme 3. The expense inflation. Here's where it gets clever and stupid simultaneously. If you're faking revenue, your profit margins will look suspiciously high unless you also fake expenses. Real stores have costs: rent, supplies, labor. If your revenue doubles but your costs stay flat, auditors will ask questions. So Luckin also inflated expenses by over $190 million. They created fake supplier invoices, falsified purchase orders for coffee beans, cups, milk, syrups, supplies for all that phantom coffee they weren't actually brewing. They even altered accounting records in bank statements to make the fake purchases look real. It was fraud on fraud, a matryoshka doll of deception, each layer designed to cover the layer beneath. By the time it was over, Luckin had fabricated more than $300 million in sales, almost half its total reported revenue for 2019. Q2 2019, revenue overstated by 28%. Q3 2019, revenue overstated by 45%. The company was reporting rapid growth and improving metrics. In reality, stores were losing money, customer acquisition was stalling, and the entire narrative was fiction. But here's the thing, everyone wanted to believe. Investors had poured hundreds of millions into Luckin. Venture capital firms had reputations on the line. Chinese nationalism was wrapped up in Luckin's success. It was beating an American company on Chinese soil. And Lu Zhengyao had done this before with cars. Why wouldn't he do it with coffee? So when the numbers looked too good, people convinced themselves it was real. Meanwhile, at Luckin HQ, employees were forging documents, moving money between shell companies, and maintaining dual accounting systems, one for auditors, one that showed the truth. But in January 2020, someone inside Luckin decided they'd had enough. The report was 89 pages long, anonymous, devastating. It hit Twitter via Carson Block and his firm Muddy Waters Research, the same short sellers who'd exposed previous Chinese frauds like Sino-Forest. The document was methodical, professional, clearly written by someone with deep knowledge of Luckin's operations, someone who'd been inside, someone who had receipts.
Luckin Coffee is a fraud, the opening stated bluntly. Based on the research, we believe Luckin is fundamentally a broken business that is burning through investor capital at a highly elevated rate, while reporting fraudulent financial and operational metrics.
The report detailed the field research, 11,260 hours of store observation, 620 locations monitored, 25,000 plus pieces of purchase data analyzed. The findings: store-level item sales per day inflated by approximately 69%. Average selling price inflated by approximately 12%. Store-level sales inflated by at least 88%. Luckin stores were deeply unprofitable. The company was burning through cash at an unsustainable rate.
The anonymous authors had also analyzed Luckin's supply chain. They noted discrepancies between reported materials purchases and what stores actually needed. Too much milk, too many cups. Purchase orders that didn't match any reasonable estimate of actual beverage production.
The company reports numbers that are completely divorced from the underlying reality of its business, the report concluded. But who wrote it? The document never said, but the level of detail suggested insiders, possibly multiple employees, finance staff, or operational managers who'd seen the fraud firsthand and couldn't stay silent.
January 31st, 2020, Luckin stock opened at $36.40. By market close, $32.49. A decline, but not catastrophic, about 10%.
Why not more? Because Luckin immediately issued a denial.
February 3rd, 2020, Luckin's board held an emergency meeting and released a statement dismissing Muddy Waters' conclusions. The company believes that the Muddy Waters report is misleading and contains numerous errors, unsubstantiated statements, and mischaracterizations.
CEO Qian Jia went on Chinese media, confident, defiant. Our numbers are real. We have audited financials. This is a short seller trying to manipulate our stock. The stock briefly recovered. Chinese investors rallied around Luckin. Many saw Muddy Waters as American short sellers trying to take down a Chinese success story. National pride kicked in. But behind the scenes, panic was setting in.
Luckin's external auditor, Ernst & Young, began digging. The Muddy Waters report had raised enough red flags that even if Luckin denied everything, EY needed to verify the numbers before signing off on 2019 financials.
They started asking uncomfortable questions. Where did all these corporate voucher sales come from? Can you provide details on these related party transactions? These purchase orders for supplies, can we see the actual invoices from vendors? The Luckin team scrambled. They provided documents, answered questions, hoped EY would accept the fake database numbers and move on.
But EY kept pushing, and in late February 2020, they found something that didn't add up.
The fake operations database had a problem. Some of the inflated transactions didn't match up with the bank records that EY had access to independently. Revenue that Luckin claimed had been received wasn't in the banks. EY raised concerns internally. They weren't ready to call it fraud yet, but they weren't signing off on the financials either.
The internal investigation.
In early March 2020, Luckin's board, under pressure from EY, launched an internal investigation. They brought in outside counsel. They started interviewing employees. They began reviewing the accounting systems. What they found was worse than anyone outside Luckin had imagined. The fake operations database, the fabricated voucher sales to related parties, the inflated expense records, the altered bank statements, the web of shell companies moving money to create the illusion of revenue. It had started in April 2019, right after the IPO. As the company's growth started slowing organically, management decided to fake it, create artificial momentum, keep investors excited, keep the stock price up. COO Lu Zhengyao was at the center of it, but he didn't act alone. CFO staff were involved, regional managers knew, IT employees had built the fake database. This wasn't one bad actor. It was systematic fraud involving dozens of employees. And at the top, CEO Qian Jia, Chairman Lu Zhengyao. The question investigators wrestled with, did they order the fraud, or did subordinates inflate numbers to meet impossible growth targets and leadership looked the other way? Either answer was damning. April 2, 2020. Luckin Coffee issued a statement that would make financial history.
The company announces that it has identified fabricated transactions amounting to approximately RMB 2.2 billion, $310 million from the second quarter of 2019 to the fourth quarter of 2019.
The statement blamed COO Liu Jian and his direct reports. It said an internal investigation was ongoing. It suspended Liu and other employees pending further review. But the numbers were clear. Nearly half of Luckin's reported 2019 revenue was fake. The market's reaction was immediate and brutal.
Stock price on April 1st, 2020, $26.20. Stock price on April 2nd, 2020, $6.40.
A 75% drop in a single day. $8 billion in market value? Gone.
Goldman Sachs, which had lent Lu Zhengyao $518 million secured by his Luckin shares, immediately moved to seize and sell his stock. The margin loan was now massively underwater. Goldman wanted out. Credit Suisse and other banks that had participated in Luckin's bond offerings, $400 million in convertible bonds issued just weeks before the Muddy Waters report, watched those bonds collapse. They traded down to 10 cents on the dollar.
Investors who'd bought in the IPO or secondary offering wiped out. Pension funds, retail investors, institutional funds, billions in losses.
And the people who'd known all along, the employees who'd filed the anonymous report, who tried to warn the world, they watched vindicated as the house of cards collapsed exactly as they'd predicted.
But the chaos was just beginning. Trading in Luckin Coffee shares was halted. The exchange needed to determine if the company could continue to be listed after admitting to massive fraud. The answer, everyone knew, was no. It was just a matter of timing.
April 15th, 2020. Goldman Sachs officially seized Lu Zhengyao's shares and began liquidating them on the open market. The man who'd been worth billions on paper saw his wealth evaporate. His Luckin stake was now worth almost nothing, and Goldman was selling it to recover whatever they could from the margin loan.
May 15, 2020, NASDAQ issued a formal delisting notice. Luckin had publicly disclosed certain potentially fraudulent transactions and had failed to meet continued listing requirements. The company had until May 22nd to appeal. They didn't bother. May 20th, 2020, trading resumed briefly, one last chance for investors to flee. The stock plummeted another 20% after the Wall Street Journal published a report showing that the fraud went deeper than initially disclosed. Firms linked to Chairman Lu Zhengyao had played a central role in creating the fake transactions.
Lu's entire empire was imploding. Not just Luckin, but Car Inc. and UCAR, both companies tied to Lu, saw their stock prices crash as investors questioned whether the same fraud had infected Lu's other ventures. June 29, 2020, Luckin officially delisted from NASDAQ. 13 months after going public with such fanfare, the company ceased trading on any major exchange.
The SEC moved quickly. By June, they charged Luckin Coffee with defrauding investors by materially misstating the company's revenue, expenses, and net operating loss in an effort to falsely appear to achieve rapid growth and increased profitability.
The complaint laid out the 3 fraudulent schemes in detail. It showed how Luckin had raised more than $864 million from debt and equity investors during the period of fraud, money obtained under false pretenses. China's market regulators also launched investigations. In September 2020, they fined Luckin and related entities a combined $8.98 million, a slap on the wrist by US standards, but significant for China.
The US Department of Justice opened a criminal inquiry. Would executives face prosecution? Would anyone go to jail?
The board moved to contain the damage. Fired. COO Can Jia. Fired. CFO Reinout Skakel. Fired.
Several other senior executives and managers were terminated. The board installed Guo Jinyi, yet another former Car Inc. executive, as the new CEO.
But Chairman Lu Zhengyao stayed. For a while.
Lu tried to maintain control through various board maneuvers. He had allies on the board, he controlled significant voting shares, and he believed he could salvage the company.
It didn't work.
By July 2020, facing pressure from creditors, regulators, and public outrage, Lu was forced out. Not quietly, not gracefully. Banks had won court orders in the Cayman Islands and British Virgin Islands to liquidate Lu's controlling entities. His empire was being dismantled piece by piece.
In July 2020, Cayman Islands courts appointed joint provisional liquidators to oversee Luckin's operations. The company was essentially in bankruptcy, trying to negotiate with creditors who'd been defrauded and wanted their money back.
February 2021, Luckin filed for Chapter 15 bankruptcy in the U.S., a process that allows foreign companies to restructure debt in American courts.
The situation was ugly. Creditors fighting over scraps, investors demanding accountability, employees worried about whether stores would stay open. But here's the crazy part. The stores kept operating. Throughout the scandal, bankruptcy, to listing, Luckin Coffee stores across China stayed open. Customers kept buying coffee. The app kept working. Delivery continued. Because underneath the fraud, there was an actual business. It wasn't as successful as the fake numbers claimed, but it existed. Thousands of employees still showed up to work. Millions of customers still wanted cheap, convenient coffee. December 16, 2020, Luckin reached a settlement with the SEC. The company agreed to pay a $180 million fine without admitting or denying the allegations.
It was one of the largest penalties ever imposed on a Chinese company by U.S. regulators. But compared to the $310 million in fake revenue and the billions in investor losses, it felt inadequate.
Individual executives faced consequences too. Former CEO Qian Jia and former COO Lu Zhengyao were charged by the SEC with fraud. They were permanently banned from serving as officers or directors of any U.S. public company. China's regulators fined Lu Zhengyao personally 300,000 yuan, $46,500, for information disclosure violations, a laughable amount given his role in the fraud. But none of them went to jail. No criminal charges stuck in the US. In China, the penalties were financial and reputational, not criminal. Class action lawsuits piled up. Investors sued Luckin, the underwriters who'd helped with the IPO, Credit Suisse, Goldman Sachs, Morgan Stanley, etc., and the executives. These lawsuits sought billions in damages. In December 2021, a federal judge approved Luckin's restructuring plan. The company settled numerous class actions, restructured $460 million in debt, and emerged from bankruptcy protection. But the question everyone wanted answered: how did auditors miss $310 million in fake revenue? Where was Ernst & Young when all this was happening? EY had audited Luckin's 2017 and 2018 financial statements, the numbers used in the IPO prospectus. They'd given clean opinions. Investors had relied on those audits to justify investing hundreds of millions. Then 2019 turned out to be almost half fabricated. EY's defense: they'd only audited through 2018. The fraud began in April 2019, after the IPO. By the time they were auditing 2019 financials, which would have been in early 2020, they discovered the irregularities and raised red flags. That's what triggered Luckin's internal investigation. But critics pointed to a damning detail. In May 2019, right before the fraud started, EY had written a private letter to investment banks stating they had no issues with Luckin's financial performance in the first 3 quarters of 2019.
That letter was issued before 2019 financials were even audited. It was essentially EY giving comfort to underwriters and investors based on preliminary reviews.
That comfort letter helped Luckin raise more money. It gave investors confidence. And it was issued during the exact period when the fraud was either beginning or about to begin. EY faced scrutiny. How could sophisticated auditors miss fake databases, fabricated voucher sales, and inflated expenses? Luckin had been really good at hiding it. The dual database system meant auditors saw clean numbers. The related party transactions were structured through shell companies that appeared legitimate on paper. The fake purchase orders came with forged invoices from real suppliers or suppliers who were complicit. Modern accounting fraud isn't done with pencils and erasers. It's done with sophisticated software, fake digital records, and layers of complexity designed specifically to fool auditors. But that explanation didn't satisfy investors who'd lost billions or regulators who'd been embarrassed. Luckin's fraud had consequences far beyond one coffee company.
In May 2020, just weeks after Luckin's confession, the U.S. Congress passed the Holding Foreign Companies Accountable Act. The law requires that foreign companies' auditors must allow the Public Company Accounting Oversight Board, PCAOB, to inspect their audit work.
China had long resisted allowing US regulators to inspect Chinese auditors, citing national security concerns. But after Luckin, and previous frauds like Luckin, Congress decided enough was enough. The law gives companies 3 years to comply. If their auditors can't be inspected, they get delisted from US exchanges. Hundreds of Chinese companies suddenly faced the prospect of forced delisting. The law was directly triggered by Luckin and similar frauds. One coffee company's lies had reshaped international financial regulation.
Investor confidence in Chinese companies cratered. Other Chinese firms listed in the US saw their stock prices decline as investors questioned whether more Luckins were hiding in plain sight.
Short sellers circled Chinese stocks like sharks smelling blood. Every Chinese company with rapid growth got scrutinized. Every set of financials got questioned.
The reputational damage to Made in China was severe, not just for products, but for Chinese financial reporting, corporate governance, and business ethics.
But here's where the story takes a bizarre turn. Luckin Coffee survived. After bankruptcy restructuring, after executive purges, after delisting, the company not only survived, but thrived.
By 2022, Luckin had emerged from bankruptcy with a completely new leadership team. The fraudsters were gone, the books were clean, and the actual business underneath all the lies, it worked.
The stores were profitable once management stopped burning cash on fake growth. Customers actually liked the coffee. The app-based ordering was genuinely convenient. The prices were competitive. Without the pressure to show hypergrowth to investors, Luckin could focus on running a sustainable business. By mid-2022, Luckin reported positive net profits. They were opening new stores, real ones, with real customers, generating real revenue. By mid-2022, Luckin reported positive net profits. They were opening new stores, real ones, with real customers, generating real revenue. By June 2024, Luckin had 7,195 stores. By July 2025, over 26,000 globally, more than Starbucks in China. The fraud had been exposed. The fraudsters had been purged. And underneath, there actually was a viable coffee company. Investors who'd bought during the crash and held through bankruptcy made fortunes. The stock, now trading over the counter and later relisting in Hong Kong, climbed back from the ashes. It's one of the strangest corporate turnarounds in modern business history. A company that committed massive fraud, imploded publicly, restructured in bankruptcy, and came back stronger. And Lu Zhengyao? The disgraced founder whose fraud had destroyed billions in value? He wasn't done. In 2021, after being kicked out of Luckin, Lu launched a noodle restaurant chain called Xiaomin Riji, Noodle Diary. Same aggressive expansion model, same earn cash for growth strategy, same team. Many former Luckin executives joined him. It didn't work. Most locations closed within a year. Then he launched a pre-cooked meal business. Also failed. Then, in 2022, Lu circled back to coffee. He launched a new chain called Luckin Coffee, positioned as a pan-coffee lifestyle brand, serving coffee, tea, meals, snacks, and alcohol. The audacity was staggering. The man who'd committed one of the biggest coffee frauds in history was starting another coffee company. We, a team of coffee dreamers, have embarked on a new journey, Lu posted on WeChat, celebrating Luckin's first store opening in Fuzhou. Some people never learn. Some people can't help themselves. And some people are genuinely convinced that the fraud was just a minor speed bump on the road to building great companies. Lu apparently fell into all three categories. There's a Luckin Coffee on nearly every block now. Blue and white logos, clean, modern stores. The app works perfectly. You order, pay, wait 3 minutes, pick up your latte. It's cheap, fast, convenient. Nobody talks about the fraud anymore. The stores are busy. Customers are happy. The company is profitable. It's like 2020 never happened. Except it did happen. $310 million in fake revenue. $11 billion in destroyed market value. Thousands of investors who lost their life savings. Employees who committed fraud because their bosses demanded impossible numbers. Auditors who missed or ignored massive red flags. It all happened, but corporate memory is short. Investor memory is shorter. And Chinese consumers? They just want their coffee.
The scandal exposed fundamental problems in how we value companies, how we audit financial statements, how we regulate cross-border markets, how we incentivize growth over sustainability.
None of those problems got fixed. Lu Zhengyao is running a new coffee chain. No criminal charges, no jail time, just some fines and a prohibition from running US-listed companies, which doesn't matter if you never plan to list in the US again. EY continues auditing major companies worldwide. Some reforms were made, some procedures tightened, but accounting firms still rely on management's representations, still trust the documents provided, still can be fooled by sophisticated fraud. And investors? Still chasing growth stories, still believing the next hyper-growth narrative, still willing to overlook red flags if the returns look good enough. Somewhere in China right now, a startup founder is looking at Luckin's story and learning the wrong lesson. They're not learning, don't commit fraud. They're learning, make sure you don't get caught. And if you do get caught, have a real business underneath to fall back on.
Somewhere in America right now, an investor is looking at a Chinese company with explosive growth numbers and thinking, this could be the next Alibaba. They're not thinking, this could be the next Luckin.
The cycle continues. Because here's what Luckin Coffee really proved. In modern markets, perception is reality until it isn't. You can fake success long enough to actually achieve success. You can lie your way to the truth. 18 months from zero to NASDAQ. 11 months from hero to zero. 4 years from bankruptcy to comeback. That's the Luckin Coffee story. China's Starbucks that brewed success by cooking its books. The fraud that became a phoenix. The scandal that everyone forgot. $310 million in fake sales. But the coffee? The actual coffee that Luckin sold to real customers in real stores? That was never the point. The point was the story, the narrative, the growth numbers that made investors salivate and financial media write breathless profiles. The coffee was just a prop. The fraud was the product, and the product sold brilliantly until someone counted the cups. Welcome to modern capitalism, where the fake can become real if you move fast enough, raise enough money, and survive long enough for everyone to forget what you did. For more content like this, hit the subscribe button.